Well, I think one of the things we should start to look at now is perhaps whether the old methods of measuring bank are still effective in terms of capital ratios and asset ratios and cost-income ratios. At the Banker, we have a top 1,000, which we produce every year in July, and we've always used Tier 1 capital as our way of ranking banks. Ian, is that an effective way going forward?
It depends on losses, because if you put in a form of capital that counts as Tier 1, but is senior to real equity, as you lose money, it's written off against the equity. And ultimately, what you're doing is you're actually gearing up common equity. So that's why common equity has become much more volatile. The cost of common equity has clearly gone absolutely through the roof. And that, in essence, is why the UK government ended up exchanging prefs into common equity, because if you've got losses, you can only write that off against something that absorbs losses. And at the present moment, we're not actually writing off losses against hybrids and Tier 1s and other instruments. It's been written off predominantly against common equity. So yes, other forms of Tier 1 capital and total capital are relevant, but if you need capital because you've got a loss that you've got to replenish, then there's not much point replenishing an actual loss with an obligation to repay someone in 10 years' time or 20 years' time or something like that, because that's actually apples and oranges.
Yeah.
So, and the equity markets implicitly understand that. And I think an issue that the banks have got in terms of the recapitalisation is a lot of the government money is not necessarily pure equity. It's often in other forms of instruments, and it could be interpreted like that as being almost like bridge equity rather than permanent equity, because at some point it will need to be repaid, and or if there are losses, it probably need to get converted into core loss absorbing equity. So that's why people relatively disregard the total capital, because you've seen the mess that Deutsche got into when it didn't call its subordinated debt. So I think if the bank sector needs to recapitalise because of losses, then it's got to find an instrument that absorbs those losses. And at the moment, that is core equity. Maybe it will turn into preference shares, but the feedback loop of applying losses against preference shares or hybrid would be extremely large at the present moment, because at the present moment most bank workouts are working in a way that's relatively benign to other levels of the capital structure, and the capital markets are in a bit of a funk even despite that fact. So if you start to write off incremental losses against sub-debt or Tier 1, I think that we'll find another leg down in the capital markets, and governments want to avoid that.
Ambrose, you agree with that?
I totally agree. I think that nevertheless the banking community should challenge the analyst's view that there is a minimum level that should be above the consensus regarding core Tier 1. I mean, obviously the banking sector has to deleverage, but it doesn't make sense to, in a very difficult environment, to be pro-cyclical, asking for core Tier 1s of banks, regardless of the status of the bank, of its health, to be at 7.7% or 6.5% or even more. I mean, we are quite vocal against the certain features of the pro-cyclicity of the accounting standards. We should be as well vocal against the pro-cyclicity of the core Tier 1 analyst requirements.
Leverage is very interesting, isn't it? Because I remember early on in the crisis, 12 months ago, we were all worried about the monolines as a sector. And I looked at some data on the monolines, and it turns out that they had net par outstanding of about $2.5 billion. And a very low amount of common equity of about 40 billion or so. So the gearing was at 80 times or something like that. And then one of my colleagues said, actually, that's quite like quite a lot of international banks. And he was absolutely right. I mean, there was just one bank alone. And there are many banks that have now still got 2 trillion type balance sheets. Those are massive balance sheets on relatively small amounts of equity. And in essence, what we've had is we actually had two banking systems. We had one that was regulated, but clearly in ways that the regulators didn't fully understand everything that was going on. And we had another banking system over here, the shadow banking system that David referred to, estimated at somewhere between $1 and $2 trillion. It was not regulated at all. And basically that's either A, collapsed or come back onto the balance sheet of the banks. And as fast as the banks try to delever, then you get things that push up the leverage ratios, which are ratings migration as an instrument, because of the ratings model, as an instrument goes down the rating scale, the capital requirement goes up. We have a client who had one set of investments where the risk-weighted assets on those investments went from 1 billion to 15 billion euros in the space of 1 quarter. Massive expansion of, you've got VaR assumptions going up, so your trading book requires a huge amount more capital. You've got commitments that were unfunded now becoming funded because people want to borrow from the banks. So as much as the banks try desperately to delever their balance sheets and get them down, all these factors keep pushing them up. And it's incredibly stubborn, the pace of deleveraging, unfortunately, and I suspect that is what's going to drag out for quite some time to come, because it's incredibly difficult to shrink bank balance sheets as quickly as you might want them, either because you then take on massive losses that you can't afford to take because it'll hit your capital, or because of these countervailing factors that tend to push it up again.
On top of that, there is a problem of competition there, because I think that these toxic assets are in fact concentrated on a few balance sheets, and therefore I think that obviously there is a systemic risk letting these institutions go, because if they've got to sell these assets nowadays, the magnitude of the losses would wipe out all their equity. So it's not possible to let go the Belgian banks. It's not possible to let go Hippo Real Estate. Nevertheless, on the other end, I think that for that reason there should be a public support for these banks, but these banks should pay the price of it, and otherwise it would be a subsidy. Definitely the ING scheme is some sort of subsidy, and I would not comment because I don't know what is the terms and conditions of the BNS scheme support for UBS, but I think there are in fact we should differentiate between the banks that are in need of such supports and make sure that these banks are not subsidized, and the others that are going to take care of themselves, like in the past, managing smoothly their assets.
And to be fair, the EU Commission is very, very focused on that. I mean, there is a clear distinction being drawn between those banks that have encountered difficulties but have a business model, and those that don't.
And your view is that argument with no subsidy should take place, even though that might mean that we would see 6, 10 nationalizations in Europe, same in the US.
No, I think that an insurance scheme or a segregation of assets with a public guarantee could be given, but there should be these should be balanced by very stringent obligations on these banks. Otherwise, there will be distortion, and these banks should be kept alive for systemic, obvious reasons, but they should not be subsidized. Otherwise, we're going to see the nationalized bank or these banks going back in the market, making stupid things. That's for sure.
And presumably also, I mean, the other key part, and this is true of any sort of guaranteed scheme, we need to work out, if you like, the expiry date. How do you phase it out? When do you phase it out? How do you kind of wean the system off?
I actually think that this is the point where many governments are on the horns of a dilemma, because I think governments are trying desperately to avoid nationalising the banks, and I think they also want to avoid subsidising the banks, and unfortunately it's very difficult to reconcile those two things, because if the quantum of assets that you want to put into the bad bank is very large, and the risk of them is quite large, then the cost of the insurance that a third party would want to charge to avoid subsidising the banks is very large. If you apply that charge to the current capital base and the share price of the bank currently today, you may find that that actually equates to a very, very substantial proportion of the equity.
It's de facto nationalisation.
It's de facto, and that is the thing that governments are struggling with at the present moment.
And that brings us full circle, because that brings us exactly to why equity valuations and hybrid capital valuations are where they are, because it's the spectre of nationalisation which is haunting them.
Right, massive dilution.
All right.
What I don't think regulators quite realised is the banks can be too big to rescue. You know, the default of a bank can lead to the virtual default or the need for a rescue of the whole country. And we clearly have seen that now in Iceland, arguably Ukraine, Hungary, and other places. So, and even, you know, let's face it, even the UK and Switzerland have had a real shock to realise how big these banks are relative to the size of their country. And so you do get into some quite troubling questions. If in 10, 15 years' time those banks recover, grow again, I mean, you could find that they're, you know, again, exponentially larger than the size of the country and too big to rescue.
But I would have to agree. I mean, isn't that what we spent the last 20 years with the various incarnations of Basel struggling towards minimum international regulatory standards? I think the challenge...
It's a different point. It's actually a different point. The issue is not whether the bank is holding enough capital against its risks. The point is, who is the lender of last resort to a bank that is so big that the country can't afford to be the lender of last resort to it? That's the issue.
But that, it comes back to, frankly, that's the responsibility of the national regulator to say, okay, is it appropriate that I have a banking system, let alone individual banks, which are so much more at times a multiple of my GDP and taxable revenue base. So it's not. I think it's very hard for somebody in Washington to say to the Russians, you know what, I think this bank's really getting too big for your economy. It's the job of the Russian regulator within the international framework to say, you know, I think your loan-to-deposit ratio is out of whack.
But perhaps that underscores your point, that if you have international regulation, it has to be married with, it can only work if it's married with an international body that can also provide this provider of capital of last resort, whatever. You cannot have one without the other. It's simply not feasible.
There is an ongoing attempt at the European Union level to set up such a regulatory supervisory body. There will be a report issued at the end of the month of February by a committee chaired by former IMF chairman or general director de la Rosière on that.
Right.
So I think that we will see things moving, and I think that there will be something in the G20 definitely on that issue. But let me just say that we are obviously entering into a phase of domestic retrenchment. Obviously banks, a lot of banks are going to refocus geographically, refocus in terms of businesses. The flip side of that is that there is no buyer for the assets they would like to dispose of. So I don't think that we are off with the universal bank model. First, because it makes sense to diversify. Second, because the domestic retrenchment will not last for years, and third, because definitely there are a lot of businesses, and I would agree, including retail banking, where you can extract synergies and cross-fertilize good practices. And I do think that maybe the global model has disappeared with Citigroup, but the international bank model is going to stay. And the winners will be international banks.
In Citigroup's case, I don't think it was their global retail platform that was the problem.
No.
So
I agree. It was all the other things.
Okay, gentlemen, let's leave it there. We're out of time. Thanks very much for a fascinating discussion. I'd like to invite you all back next year to see how far we progressed.